having it put on to my other screen, so we'll see. There's usually a lag, so it'll kick in. Sarah, how are you doing?
Good. Another busy day in paradise. How are you?
Are you guys deploying capital?
We sure are. Yeah, we are the most active VC in the Great Lakes region. Fun fact. So we are always deploying capital. It feels like we have a quite the list of companies in DD right now.
Oh, nice. Yeah, when you have institutional money, it really doesn't matter, right? As far as like having to kind of ease up on that kind of stuff, doing community development.
Right. Exactly. Yeah, we have a tranche of SSBCI funds we're working on right now.
Okay, we'll just let some people kind of get in. If you guys want to come in and say who you are, that will be great in the chat. And wait a minute or so, and we will get started on red flags that founders say. All right. Well, you want to get started?
Sure.
Okay. Well, Sarah, how you doing? Why don't you just give the audience a little bit of background on who you are and where you work, and I'll do the same, and we can get right into it.
Perfect. Yeah, I'm Sarah Mohendro. I'm a principal at Elevate Ventures, joined back in February. I manage our due diligence process on our investment team. And Elevate Ventures is part venture development, part venture capital. So we make investments in Indiana-based companies, both return seeking and also to help develop the entrepreneurial ecosystem in Indiana. And we provide other entrepreneurial development programmings too, like grant matching, an accelerator, education, coaching, things like that.
And everybody, my name is David Paul. I am the principal and managing director at DWP Capital. We are a venture capital and early growth equity firm that specializes in vertical SaaS and B2B tech-enabled services. We write checks from 1 to 3 million, usually in rounds that are 2 to 5, companies that are kind of seed, Series A type frame, and help them get to the next inflection point. So today, what we're going to do is we're going to talk a little bit about how some red flags that people on our side of the table see when founders are pitching, because I think it's a well-known fact that people believe that what's inside of an investor's head is a black box, and we want to show some visibility into what we're thinking when we hear certain trends or things that people say, and give the reason why. So with that, Sarah, do you have anything to add to that before we kind of go into the 5 main areas of a business pitch?
No, sounds great.
Okay, so founder comes into you, he gives out a particular pitch deck. First thing he does is talk about market size. What are some of the things that you feel are kind of red flags that a founder may or may not say?
Yeah, I think one is having a focus on a specific target market. So everyone wants to have a big market size, of course, but you can have too big of a market. When you're first going to market, you want to be focused on a specific type of target customer and understand what that market looks like. And then from there, understand how that can expand to other markets and to your total addressable market. But it is a red flag for us if someone comes in and they're trying to sell to all these different groups and types of customers and they don't have a good handle on what that initial market is.
Yeah, I think the TAM slide might be the most useless slide in a pitch deck. How I see it is, generally like there's TAM, SAM, and SOM, and those different areas mean different things. I really care about that bottom, the smallest part of that segment of who are you going to attack initially, and why, and how much do you actually know about that target market?
I agree 100%. And what research did they do and where did they get those numbers from? And are they accurate is another, big part of it.
Yeah, it's not like I'm going to fact check you, right? I just need to know that you know what you're talking about.
Right, exactly.
Because the bottom line is that, being in a startup is hard, but, when you're raising capital and you're pitching a story and you don't have much to show except for yourself and your story, like that needs to be pretty buttoned up, right? And so, when you go and you're pitching your story, you really want to make sure that you're super granular, specifically in the early stages. And what happens at that early stages in the bottom part of the SOM, Sarah, what if that's too small? Like, what if that's not a 10x of what an investor needs to see?
Yeah, we will, sometimes consider smaller markets if there's, an additional platform play involved. Like, maybe we're focused on this little market today, but, a few years down the road, we're going to be able to apply this to this market and that market. And there's a clear path to get there. Then we'll think about, the broader opportunity set there as well. But having, too small of a market and not a clear path for other opportunities would definitely be a concern.
Yeah. I mean, my feeling of that is, if let's say a market is 50 million and you're a 10 to $15 million business within that $50 million market, to me, that's a pretty valuable company.
Mm-hmm.
I mean, that means you have a stranglehold on a market and the chances of being displaced are very small.
Yeah, and I think especially if it's an underserved market, if it's a really competitive market, you're going to have a hard time capturing that market share for it to be meaningful. But if it's a small, underserved market, that's where you can make a lot of money.
Yeah, I like lots of value within a small market.
Yeah, that's a good way to put it.
Okay, cool. So market. What's the next? Let's talk about product. What are some of the product kind of red flags that you see within a founder pitch?
Yeah, I want to hear about how you're actively validating that product market fit. Like, what have you done so far to get that feedback? And how are you capturing that feedback today? And then how are you implementing that into your roadmap? I think customer feedback and product market fit should be, really key to product development. And so if they're not thinking about that and collecting that feedback, that would be a big concern.
Sure. And then what about like when they talk about features and and how they can stack up to the competitor?
Yeah, I don't necessarily want to see like a laundry list of features. I want to understand what the value proposition is. Like if you have 10 features, but only 2 of them are being used and adding value to the customer, how does that compare to what the competitors are doing? If you have extra features, but they're not adding value, even if your competitors aren't offering that, is it really important?
Yeah. Did you not think they thought about that feature?
Right. Exactly. Yeah.
Right. I love how, when founders come in to make a pitch and they tell about the legacy competitor that's, the 15,000-pound gorilla in the room, and they say how everybody hates them. Like, oh, that their software, it's very clunky and everyone hates them. Mm-hmm. Well, I mean, if everyone hates them, generally they would normally be displaced and they wouldn't be able to get to a scale that they currently are. How I look at products and features is I never want to try to say a product with this feature is going to get a competitive advantage, because then you kind of get that feature creep, right? When you kind of go, and if you're, going, tit for tat with other companies on features, generally speaking, the company that raises the most money is going to win. Mm-hmm. I prefer, when looking at an earlier stage company, to really focus on what is the market positioning of the company. Like, how are you positioning yourself? Like, maybe you only do these things well, but like there's a reason for that. And it's because that subsector of this stack, right, is super underserved. And there's a litany of features that can go on underneath that, and that which is worth exploring. Because, you know, if you come to market with just trying to like, go, pull a platform from an existing platform, like changing costs are real.
Mm-hmm. Yeah. I think that goes back to market a little bit too, of how are these features and this value proposition serving this targeted group, and what features does that group want to see. And that's one way you can differentiate yourself, is by going after a certain group and creating a product to serve that group versus creating a more general product maybe your competitors are doing and try to displace them that way.
Mm-hmm. And another thing is, I'm not going to be able to validate if your product's that better, much better anyway. You know, it's like, I'm not going to, like, I can't go into the competitor. I don't know what their roadmap looks like. You know, I don't know what their stack looks like. I don't know how much, decay they have on the tech side. So it's too, I can't believe you for that reason.
Yeah.
Okay. So what about founders and how they describe themselves and how they describe their team?
Yeah, this is one of the, I think, biggest areas of focus for us when looking at really early stage companies, is the founder. I think the biggest thing we look for is coachability. If a founder comes in and you start asking questions and they're being defensive or they seem very arrogant, like that's a huge red flag. A founder who's open to feedback and responsive, or even reaching out to you actively, seeking feedback and advice, like those are the kind of people we want to work with.
Do you feel like you're kind of subject to subjection bias or selection bias if you're only dealing with the founders that kind of kiss your ass?
Well, we deal with all types of founders. We wouldn't not invest in someone just because they maybe weren't super coachable. I mean, obviously, if you're like just a jerk, then that's a problem. But we work with founders, and too, like over time, sometimes their attitudes change. I think like you have to earn their trust too, right? Mm-hmm. So once they realize like, hey, you do know what you're talking about and you are on my side, then once you've built that relationship, then I think sometimes they become more coachable too.
Yeah, I think that's right. I usually have to go through a couple of rounds of phone calls and work on my side before like I start looking at, how they do under a stress test, because I need to get a little bit smarter because I don't really know about their space. But when I'm interested in an opportunity and I feel like it could be a fit for me, and I'm like, then that's when I start to kind of push and I challenge some of their assumptions, and to see how they actually react to that is very telling, to see how they're going to react, after, a funding event. Because if a founder can't keep their shit together and be cordial, like during the dating phase, the chances are it's going to get 10 times worse after.
Yeah, that's a good point. And honesty too. Like if we ask a question and you don't know, just say you don't know. Get back to us.
Yeah, I love that you don't know. And if you have to stop to think about it, I like that even better, because chances are you don't know as much because you're not in product with market, right? So like if you knew a lot, you would already have a product in market. If not, it's just you're speculating.
Yeah, absolutely.
What do you see as far as kind of the biggest resistance on coachability in your perspective? Like where do you hit roadblocks?
I think the most sensitive issues are around like the idea and the value proposition itself. Like nobody wants to hear their baby's ugly. Like it's a lot easier to say, oh, I don't like these terms, than it is to say, I don't like your idea. Mm-hmm. And so we have to be, as VCs, like really, I think, specific and do our homework and understand kind of what the specific hangups are. Like, is there something in go-to-market or product market fit that we can specifically coach them on to make this something more investable and viable, rather than just giving them broad feedback. I think founders are more responsive when you can be specific and get down to the heart of the issue and actionable advice rather than just saying you don't like something.
Yeah. What I see a lot and I get a lot of pushback on is, founders basically just overbuilding product without actually pushing it out into their, and they have all these customers that are waiting to use it, and they just need to turn it on. I always hear that we just have all this pipeline, they're all going to turn it on, and then everyone's going to start paying. I just need your check first. That's like the most counterintuitive thing I've ever heard, right? Like, if you can earn capital or earn sales today, why won't you turn it on today? And there's a reason for that.
Yeah, I think another sensitive issue we run up against in coachability is the founder's self-awareness of their role. Like, are they a product person or are they a CEO? And do they understand the difference between the two? And are they cognizant of the fact that if they are CEO, maybe someday someone else is going to be a better fit to be CEO to scale this thing? And so recognizing their role and what that looks like is important too.
Do you have that conversation like before you invest?
Sometimes I think there are a lot of good founders out there who have done this before and they understand that very well. But a lot of times with first-time founders, that takes some coaching and it's a conversation we'll have.
Yeah, and guys, by the way, if you're watching this, of course you are watching this if you're listening to this, but and you want to drop a question, please do so on the chat, and we're going to get to that at the end. So if it's top of mind, just to go ahead and drop a question. One of the biggest red flags to me, and I guess maybe this goes into market and or competition, is people that don't understand the competitors or like people that have done something similar in adjacency, and like they just say, I don't know. Like, I don't know what they're doing. I mean, that just seems to me like someone who's just, running blind into a battle that, and, haven't really done the work.
Yeah, I would agree with that 100%. And I think it's not just understanding your direct competitors, but also the indirect competitors and the other way of doing things. Like, there are software solutions that try to make things more efficient, whereas maybe before people were using like pen and paper and notes and email and stuff like that. Like, that's a competitor too. And understanding like the price and the value proposition there and why some people would still prefer to do it the old way, and recognizing that as well.
Yeah, no, absolutely. What about competition? Like, what do you have? Anything else on competition?
Let's see. I think understanding like valuation comps too is important. Like, the extent that the founder's done some research and knows how the competition has traded and how that might inform the valuation of their company is good homework for them to do and understand, so that when they're coming in asking for a certain valuation, they can back it up with some data.
Yeah, it's funny with comps. Like, I find that like if they show me a comp, I can find a comp too that
Right.
It's like, I feel like in the early stages, that's just who can find the most data. But I'm gonna pull up a scorecard that I've made, and anyone that wants it, be happy to share it. Let me see if I can get it here. Can I share this? Actually, present. Do you guys see that?
Yep.
Okay. So, when I take a look at, founders and how they take a look at it. I mean, integrity is something that, obviously is a must. This business is kind of too hard to really, deal with, people that aren't easy to deal with. Like, how can a founder really represent themselves in a way that is, of high moral character to you? And what is something that means that they may not have high moral character?
That's a great question. I think a willingness to talk about the mistakes that they've made in the past and like the lessons learned show humility and integrity to me. Making sure that what they're saying is consistent. Like if they tell me one thing and then I'm talking to another VC and they heard something else, I think that's a concern. So I think those two things.
Yeah, I agree that agreements that go soft, saying they're going to do something and they don't do it, even if it's like getting you some information, you know what I mean? Like just do what you say you're going to do. And like, that means a lot because, you're only having 30 minutes to an hour to 2 hours with somebody that's potentially going to fund your company. You want to be on your best foot. Other heuristics that I see is when people say, I took their previous company from this to that, I increased sales, I hired, I did this, and they don't use the proverbial we. That is a big red flag to me, as well as people that tried to like blame other executives, other CEO, other leadership, other investors. That is also kind of a heuristic that turns me off.
Yeah, I agree. And I think one other thing is that, most VCs can tell when you're giving them BS. So just don't do it. Just admit you don't know, or you don't understand, or you need to think more about something than try to come up with an excuse.
What about some other things? I mean, I don't want to put my whole scorecard up here and just, what are some other things from a founder perspective? What about burn? How do you think about burn?
Yeah, I mean, especially right now, that's an important one, right, in this market. Obviously, we want them to be actively thinking about that. And especially right now, if they're raising a round, we want to see that runway get them like at least 18 months. And we want them to understand, like, what do they need to do, whether that's from a burn side or a revenue side or a fundraising side, to make that happen so that they're not trying to, desperately raise money in an unfavorable environment.
Yeah, I think of burn as like, if you're trying to like just get to the next round and like, oh, we just need this before we get to Series A. That's like famous last words, right? Like if I had $1 for every time I've heard, I just need this to get to this. Like as opposed to really going into deep detail about like what you can accomplish with that capital, as much as what you think the next investor is going to, value your company for, and how much more capital they're going to put into the company. Somebody that's super like dilutive, like, because if they're into just keeping raising money, they're not really conscious about our equity as much as their equity as well.
Yeah, there needs to be a plan to get to profitability. And even if that's not next year or this round, they at least need to be actively thinking about that and planning for it.
Another thing that kind of like gets me going too, and as a red flag, is founders that say, oh, well, we're just trying to grab market share. We're just trying to grab logos.
That's a great way to grab churn at the same time.
Yeah. Grab churn, grab proven like economics, right? Like, like just if you're just trying to grab stuff and like, like just trying to like grab market share, like obviously like there's generally, I mean, you're not a scaled company yet. So, I mean, having like uneconomical business fundamentals can be dangerous unless you have a really big balance sheet behind you.
Yeah, and understanding who your target market is and going after those people and getting quality customers, not just quantity of customers.
What about like customer empathy?
What do you mean? Like,
Well, I've actually had a founder say that they hate their customers.
I would say that's a red flag.
Yeah, that's a red, or their customers are dumb and that's why they need this. Like that's, that's definitely a turn off for sure.
Yeah, the customers the customers need it because it's a better solution, right?
Mhm.
And they haven't had access to that before, not because they're dumb, certainly.
Right. So what about like when a seed stage company, they say they have product market fit? What kind of goes into your head when they say that?
I want to know how they know that, like which customers have they talked to, what feedback have they received, and can they back that up with traction?
Mm-hmm. Yeah. Yeah. And it's like, I hear it usually in combination with we've achieved product market fit. Now we're ready to scale. Right. And that's usually like the second part of of that. And, like finding exactly what they mean by product market fit, I think is really hard. One thing I'm really doing a lot with seed stage companies right now is I'm looking at product usage. Like if I like that company that you and I mentioned, we won't say the name, but we talked about earlier today. Like I said, I asked the founder, I said, well, can you show me the amount of sessions that were booked month by month, and it's de minimis. It's not that much. So it's really hard to show that this is actually a product that is being adopted. So putting gas on that is a recipe for disaster.
Absolutely. I'm curious, when you are listening to a pitch or doing due diligence and looking at financial projections, what are some of the things you look for there, or do you even put much weight on it at all?
Oh, I put a lot of weight on it because, and I put a weight on it not from the top line, but from an expense structure. So I just want to see how they plan to spend the money and like how are they going to accompany that with the revenue projections. I know they're going to be wrong, right? But like I really want to know how they like what are their levels of assumptions on the different drivers of the model, and what's their level of certainty, and how they describe their level of certainty within executing that plan is going to get me comfortable or not comfortable with the plan.
Yeah, absolutely. And where did those assumptions come from? Did they pull them out of the sky, or did they do some research and look at some historical activity?
Yeah, they're not gonna have like 100% conviction in all your drivers, right? I mean, but like just be honest about that. Like this, and this is an experiment, right? And we're like trying to figure it out. I mean, I'm cool with experiments. Just you gotta be honest about said experiment. What about like just like not so much the market, but like the market trends? Like I feel especially coming into a like recessionary type environment or a contracting economy, you bring some of these things up and people are like, well, let me tell you why this is a good thing. Right. And, it's like the counterintuitive or like the spin show. Like, how do you think about that?
Yeah. I mean, I think there are some places where that might make sense, but I think, common sense also overrides that sometimes. And it gets down to whether it's a need to have or a nice to have. Like at the end of the day, if it's just a nice to have, if the economy is going into a recession, they're going to struggle. But if it's a true need to have, then I have a little more conviction in it.
Yeah. Some demonstrable return on investment, and how do they like justify success, right, with the customer?
Yeah, absolutely. And I think it depends on the specific industry too. Like we looked at a few companies recently and even made commitments that are in like the infrastructure space. And that's really interesting because obviously the government's pouring tons of money into that right now, kind of regardless of the recession. So they have some tailwinds there. But stuff like, things that might be marketing or HR, like those going into a recession, I have a little more concern about.
Yeah, I think that it's going to be pretty hard to really make a use case if you're trying to cut software budget if something isn't integrated with your primary workflow. If like being a standard tool that's not within, you know, your system of record, like you're going to have a hard time justifying that that's needed.
Yeah, 100%.
Okay. One thing that I see too is when customers are replacing a platform with a platform, meaning they're not going into white space, they're trying to just like, you know, displace a competitor or a legacy incumbent, whether let's say it's on-prem or SaaS 1.0 products, you know, like companies that are, you know, 10, 12 years old, is they say they're winning on UI, right? And for me, like, I just feel like that really isn't the case. Like you don't displace your system of record platform workflow for UI. I mean, I would think that the real answer to that question is that you're winning on price.
Yeah. Yeah, I would agree with that.
Cool. What am I missing, Sarah?
Let's see. I think we've covered most of it. What about companies that have had to pivot? How do you look at that? Do you think that's a red flag, or can you build conviction behind that?
You know, I think it depends, right? I mean, I don't think it's a red flag. I think it's, you know, it's a reality. And I think it's how they present the information, right? If they say, we did this, we were wrong, we feel like the green shoots are this way, and this is where we're positioning to go, that would be, you know, something. But if they say, you know, we're doing this and, you know, blah, 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 blah. Like, yeah, it really comes down to how they talk about it. Right. And like, you know, and if they like, you know, downplay the customer or the product market fit, you know, part of me, I guess the red flag really comes down to is like, are they jumping to the next shiny thing? Right. Versus like, are they just not sticking with something that, you know, they can grow upon, or the customer sales cycle is too hard. Right. So that is a really hard thing to determine, is like, do you want to double down on something that's really maybe seed in concept, right? But, you know, in traction, right? Like, you know, you have $1 million of recurring revenue in a slow moving product versus a new product. Right. And I think that's all just kind of situational. What about you?
Yeah, I think that's spot on. It's all about how they present it. And I think too, it can speak to the adaptability of the team and being willing to admit that they were wrong and adjust. I think speaks really highly of them. And to your point, like there are some ideas that like I just don't get, but if it has awesome traction, then somebody's getting it, right?
Right. No,
Even
exactly.
if I don't fully understand it. And there are things that I think are cool and ultimately fall flat. So sometimes, you know, we're wrong too, and we have to be data driven.
Exactly. All right. So I think that kind of wraps us up. We have one, if anyone has questions, again, please drop them in the comments. One question, this is for Sarah. What do you mean backing valuation with data? Most founders don't have CFAs or accounting backgrounds.
I think it's easier than it sounds. Like we look at revenue multiples primarily that you can just pull off like PitchBook or whatever. So it's really nothing too fancy. And sometimes we'll go back and forth with the founders to find a comp set that we both agree on. Because to your point, sometimes it's just a matter of like who can find the most data. But you have to balance that too with the dilution and what the cap table looks like as well. So it's really more art than science.
Yeah. I mean, a lot of times, you know, I look into, okay, how much do they want to raise? And is that between 15 to 25% of the company for a dilution perspective? And I'm not really sure that's the best way to look at it, because then you're assuming the company's worth that much money, right? Or will be in the next 12 months or however, you know, you kind of make that pencil. You know, but generally speaking, you know, how much cap, I mean, it's a market, right? So, I mean, if capital's easy to get at someone to lead a $3 million round based on your traction than raising a $5 million round, then chances are your valuation is going to be lower. But, if you play that right, you could have less dilution than if you had a $5 million round. So I think people really think more about the pre-money than the actual dilution of the capital that's going into the business and what they can do with the capital.
Yeah, that's a great point. And at the end of the day, the valuation is what someone's willing to pay for it. And if you can go out and get a higher term sheet than what I'm offering, hey, good for you. And we'll consider following on a smaller amount.
I know. I was talking to a founder the other day, and he's like, yeah, somebody offered me 5 on 15. And I was like, well, I thought about taking, which is 25% dilution. I was like, well, why don't you just take 3 on 12? And he said, well, that's a lower valuation. I was like, yeah, but it's lower dilution. You know what I mean? Like, are you telling me you're like that 2 million is going to be meaningfully different, right? From, this round to that round. And I don't think that crosses. Okay. New question. David, your scorecard was showing 8 founder focused questions versus 3 company fundamentals questions. At what stage of your evaluation assessment process is this applied? Is this mainly for early stage companies that won't be able to show traction and revenue? No, absolutely. All the companies that I have to take a look at have to have revenue and traction. I think it's a function of what, how much weighting I actually put on the founder, more or less than, I from an early stage perspective, like you can have SaaS metrics, but you're not going to have several churn cycles to really make meaningful data on your KPIs and your, customer acquisition costs and your LTV. I feel like those metrics are a little bit more transitory, right? Because, companies that are in that stage don't really have enough revenue to do anything consistently in order to know what a true customer acquisition cost is baked with the full sales team, or like marketing spend that's been spent, that's giving stuff at a consistent value. So, I look at companies between 500K to 3 million. And those scorecards get applied kind of during diligence, because my mind is like bipolar during this process. Like, I'm like, I love the deal, I hate the deal. I love the deal, I hate the deal. And it just kind of keeps me honest on how I think about things. And if I'm, putting too much emphasis and emotion behind a deal that isn't that great.
Yeah, and I think too, it's important to remember that, at least for us, like scorecards are a piece of the puzzle. They're a way for us to help stay organized and like track our notes and thoughts. But that's not like the end all be all or what we're solely making investment decisions on.
Yeah. So what else besides scorecards do you use?
Yeah, we do a lot of references, professional references, founder, customer references, vendor references. We like to talk to other VCs who are invested in the deal. That's a big piece of our due diligence. We like to dig into the financials. Let's see. I would say those are some of the big things besides the scorecard that we look at, in addition to just making sure we understand the market, the product, go to market, all that good stuff. If we find a concern, it's usually something like maybe that's not captured in the scorecard. So like, I feel like the scorecard hits a lot of like the basic check the box things, but it's a lot of times more nuanced than that when you find a red flag.
Yeah. And sometimes a red flag is bigger than you gave it the weighting for it to be, right? So,
right.
Okay. I think that's everything. Unless anybody has any more questions. If you're in Indiana and you want to pitch a deal to Elevate Ventures, Sarah, how does somebody get in touch with you?
Yeah, you can go on our website and apply directly, and that'll get you connected to the right person and the right program for you based on your stage. But you're always more than welcome to reach out to me or one of the Elevate team members directly too.
And for me, if you guys are a vertical B2B SaaS company or tech-enabled service, I'd love to talk to you. We generally pull the trigger around 500K to 3 million, but we're in the business of talking to founders early. So please take time to reach out, and we'd love to have a conversation. If there's any way that we can be helpful. I also have a podcast called The Capital Stack, drops an episode every Tuesday. Best episode was with Sarah. best rated when she was, talked about transitioning from an LP to a GP. I also have a daily blog that's just filled with nonsense, really low quality content that just clears my head in the beginning of the day. But anyway, thank you guys so much. And we'll do this again next month. Bye-bye.
Thanks.